Hey everyone, thank you for joining. Just give us another minute and we'll get started. People coming in. Okay, let's get started. Uh, hey everyone, thank you so much for joining this Stablecoins 101. It is something which I've always had in mind. I just want to highlight that this is not a sponsored session. So we requested Sanjeev uh, to help us understand how stablecoins work because of his previous experience with Leap Wallet, where he was doing. And let him explain. Not the terms I understand exactly, which is why we asked Sanjeev to present this session. Sanjeev is the co-founder and CEO of Sentra. Sentra is a stablecoins orchestrator, if I'm not wrong, but we'll know very soon. Uh, I'm saying hi to all of you from Atlanta. It's 5 a.m. here. But everything all the action is in Asia Pacific right now. And obviously, right, stable coins don't have a use case in US because domestic transfers are kind of free, or maybe I'm wrong. We'll know very soon as well. But before we dive into the session, a little bit about travel and payments and what we do. I guess you already know what we do, but still, just to let you know, we are a payments consulting firm. We do everything under the payments ecosystem. There's nothing we can't touch. Until very recently, we were saying that we do everything under the payments ecosystem as long as it's not coding, no software engineering. But as fate would have it, we started even that. So if you have any payments challenge, any payments problem, which your payment gateway, payment provider, orchestrator, stablecoin provider, anyone cannot solve, please come to us and we can help you solve it. Whether it's market strategy and partnerships, expert advisory and product leadership, to do fundraising, to sales and anything extra, compliance, treasury, and FX, talent optimization. I think that's something which we've started specializing in as well, to do recruitment for the right roles, and then thought leadership. You can consider this session as one of the ways in which we do thought leadership, and usually our thought leadership is complementary. It is so that the entire community, which is the payments club, can benefit out of that. So what is payments club exactly? So Anupreet, can you go to the next slide? Yes, it's very simple, straightforward. It's a WhatsApp group. You can scan this code to join the WhatsApp group. It's fun, very active. I think at least half a dozen people have told me that that's the most active and usefully active group they have been part of on WhatsApp. So you can look forward to that. Even if you're a silent spectator, there's no doubt that there's a lot of learning coming on to that. And as G mentions, there's Payments Retreat. So Payments Retreat is a very unique, I won't call it conference, but essentially a retreat, which we are doing to have people represent yourself. If you're an engineer, you probably have missed out on GFF, SFF, MAG, or any of those payments events. If you are if you are a salesperson or a business development or in partnerships, then probably your family is like, hey, what the hell, right? Come last quarter and you're always away. This is a time where you can be away, but also bring your family along. It's at a very neat location in Bangkok, at Le Méridien Hotel. It's from 28th to 30th of November. And we are keeping the prices low. At most of the conferences, you probably pay $1,000, $2,000 for entry. Here, it's only 375 Singapore dollars. I think we ended the super early bird, so now we are on an early bird with $450 Singapore dollars, which covers all 3 days except for the stays and the flights. So please join us for the payments retreat. You can visit our website, paymentsretreat.com, which we promise will continue to grow as we move ahead. And that said, if you have already scanned the QR code to join the WhatsApp group, we'll get along and hand over the reins to Sanjeev. Sanjeev, over to you.
Awesome. Thank you so much, Vishal, for that intro and context. Yeah, and for a little bit more context for folks here, as Vishal said, we have now been building actively in the crypto space for 4 years, but payments is still new. We got into payments maybe 4 or 5 months back. And the interesting thing is that every time I would talk to somebody from the space, especially in Asia, the first question, every second conversation was, hey, have you met Vishal from travel and payments? And finally, I was like, okay, I need to figure out who Vishal is. Reached out to him. Turns out we actually were born and raised in the same city in India. We caught over breakfast, had a great chat, and that's when he was like, "This is what TNP does," and whether we'd be open to doing a session. And I was like, "Yeah, absolutely." Been wanting to sort of meet the community, and we've been learning so much about stablecoins in our journey. Would love to share that as well. So yeah, thank you all for tuning in. Hopefully, we can share some of our knowledge that we've gathered in recent times with you on stablecoins. We've tried to keep things simple. There is a lot of technical nuance here. We'll of course have time at the end for questions as well, but I've tried to keep it fairly simple. Before we dive in here, a bit of personal background and what we do. So I'm Sanjeev. I'm the founder and CEO here at Sentra. In terms of my background, started my career with McKinsey, but after that, been pretty much a startup guy for most of my life. Worked in marketing, ops, and more recently, heavily product-oriented roles. And in the last 4 years, we've been building fully in crypto. So our first product was this wallet called Leap Wallet, which essentially, for those of you who are familiar with products like MetaMask, Phantom, we're essentially what's known as a non-custodial wallet. So we operated in that space, grew the wallet to 1 million+ users, supported 80 networks in crypto. And up until earlier this year, that was kind of our only focus. But since then, we've actually launched a second product within the same business. That's called Sentra. As Vishal correctly said, we do stablecoin orchestration for Asia. What that means is something that we'll unpack maybe a little bit later in the session. But yeah, that's a little bit about us. And yeah, with that, we can get started. Just give me 1 second to this full screen. Amazing. All right. So I think the first things first, which probably wanted to address is why have this session today? Why are we talking about stablecoins? I think to me it's become increasingly clear, and I'm sure to all of you as well, that it's 2025 and everybody seems to want a piece of the stablecoin pie. I'm sure not a day has gone by for you guys in the last few months where there is no major news on LinkedIn, right? You open LinkedIn and you see talk on stablecoins. There's probably buzz about stablecoins in your company as well. Short of solving cancer, stablecoins are being talked about as the silver bullet for all problems in the world, right? I mean, is there hype? Is there substance here? I think as always, there's a mix of the two things here. But as people who've been building in the space recently, what we can confidently say is that there have been crazy amount of progress that's happened on the technology side, on the business side, on the regulation side, where we today strongly believe that we are at a sort of inflection point with respect to stablecoin and stablecoin adoptions, which is why I think it's extremely important for everybody working in the fintech payment space to understand stablecoin, what stablecoins are. And that's kind of what we are trying to do here today. And so in terms of the agenda, as I said, we've tried to keep things pretty simple. And this is roughly how we're going to go through the session, where we talk a little bit about what are digital currencies, what are stablecoins, to kind of set the initial context. We talk a little bit about why do stablecoins do better than existing payment systems, right? Why are they better? Then we talk a little bit about stablecoins under the hood with respect to what are the different parts of the stack that make up stablecoins. And finally, a little bit around the adoption, use cases, and what are we actually seeing in the real. So with that context, I think we can jump into the first section, which is about firstly what are digital currencies itself, right? Because stablecoins comes from digital currencies. I'm sure this is fairly obvious to all of you, but just to recap again, right? Digital currencies are essentially a kind of money that exists only in electronic or digital forms. as opposed to the sort of money movements and currencies that we've sort of been used to up until now. An important distinction I want to call out is that oftentimes we talk about e-wallets and other products, which essentially they take the idea of money as it was understood until now, and they've just sort of digitized the use cases around it and made it easier to sort of work with existing currencies and given people better applications. But they're still dealing with fiat currencies in the way it was known until now. Whereas digital currencies come and sort of try to change that model, where they say that these currencies, they don't actually have a form that they exist in the real world, right? Neither as cash nor in other formats, and they only live and exist digitally. And this is kind of the superset of anything we talk about from a stablecoin perspective. So I wanted to set that stage there, and everything from Bitcoin to Ethereum to all other cryptocurrencies also kind of fall under this larger bucket. Are cryptocurrencies the only types of digital currencies? No, there's actually a few of them. I think it's important to also understand the difference between these. So in the way in which we sort of understand cryptocurrencies, they're basically currencies or assets that operate on public blockchains. And importantly, public blockchains are networks that work, that sort of put decentralization first. And they operate without any particular government or a central actor being in control, right? This is, started off with Bitcoin and then Ethereum, and today you have hundreds or thousands of different blockchains. Of course, there's the idea of private blockchains, which a lot of you might have heard of in different enterprise contexts, but that's a little bit different, right? When we talk about cryptocurrencies, we're talking about public blockchains that anybody, anywhere in the world can participate in. And these definitely make up the bulk of the market share or mind share of digital currencies today. But then you also have the sort of what I like to think of as the evil twin of cryptocurrencies, which are CBDCs, which are centrally owned digital currencies. Now, depending on where you are in the world, there have been different attempts made by governments to also build out coins or currencies which have a lot of the same properties and benefits that cryptocurrencies give you, but then they are sort of on the opposite spectrum with respect to decentralization, wherein you have complete control, complete monitoring by one authority typically, and that usually ends up being the central bank of the country, right? And so depending on the different current country, for example, in India, you have the digital rupee, and different places you have different versions of these. So yeah, these form the second category. And then finally, I think a smaller section here is important to call out is you also have often platform specific currencies, you have the Starbucks tokens, and many other platforms will have these kind of digital tokens, but those operate only within a closed network of that particular company or application, right? And they don't usually are not interoperable with things outside. So that's kind of the larger sort of umbrella of digital currencies. And now stable coins particularly are a subset within cryptocurrencies, right? Within cryptocurrencies, you have a variety of tokens. A particular type of tokens called stable coins have actually been around in theory for almost a decade, in practice for maybe more than 7-8 years. And it's only in the last year or two that they've really sort of seen that inflection point in growth. But the important sort of characteristic of what makes a cryptocurrency a stable coin is typically the fact that it is sort of pegged or linked 1:1 to a particular reserve asset. Right? In the way we typically understand stable coins, we think about them as one USD being one USD, one Euro C being one Euro. But actually, you can also have stable coins that are pegged to the price of gold or a basket of currencies. But the important idea is that their price is supposed to mimic the price of the underlying asset, right? And this is what makes them really helpful from the standpoint of whether it's payments, whether it is booking your profits as a trader, whether it's holding your treasury as a company. For those of you who have sort of read the original Bitcoin white paper and have a context around how Bitcoin started, the idea of Bitcoin also was to do peer-to-peer payments, right? So payments were very much rooted as an essential part of Bitcoin and blockchain design. But the problem is that nobody wants to trade, nobody wants to pay in an asset which can sort of depreciate in value day over day, or sometimes even hour over hour, right? Which is why payments never really took off until stablecoins did. So now with stablecoins, you have an asset that is pegged, in this case, let's say to $1, and that makes it much easier for a business to operate without the uncertainty of price fluctuations. So that's really what like stablecoins do, they're pegged, they're supposed to offer like, minimum volatility. And because they're cryptocurrencies, they come with a variety of benefits that blockchains give us, which is you get instant settlements, you get programmability, availability 24/7. We'll cover all these in a bit more detail, but that's kind of like what stablecoins gives us. Now, this is where we can get lost in a lot of details, so we'll try to keep this pretty high level. But actually, if you look at the sort of evolution and history of stablecoins, there are a variety of stablecoins. Right? A lot of us have probably heard about USDT from Tether, USDC by Circle. These are, of course, the largest stablecoins. They're what is known as fiat collateralized stablecoins, where the idea, in a sense, is that somebody who wants to, let's say, go and the word here is mint. Somebody wants to go and mint a certain amount of, let's say, USDC. They go to Circle, which is the stablecoin issuer in this case. You give Circle $100, 100 US dollars, and Circle then is able to mint 100 USDC on a particular blockchain, right? And so the idea here is that only as much as reserves are held, is there going to be that much minting of the stablecoin that happens on chain. And hence the idea is that in a scenario where suddenly, let's say, there's a bank run, there's people trying to get out of like stablecoin back into fiat, there's always a 1:1 backing between the amount of fiat that these issuers hold and the amount of like, stable coins that they're actually minting. Now, of course, there's again a lot of nuance in terms of how are these assets held, how are they publishing it, are they actually like holding it in not cash form or other form. So a lot of like, nuances here, but I think important to note that this is the high level of how this works. Now, there are also a bunch of other types of stable coins. Right? Very quickly, what some of these other ones look like is you might have crypto collateralized stable coins, where rather than putting in a certain amount of USD, you could put in a certain amount of ETH or some other token, and then use that as a collateral to mint a certain amount of like, USD stablecoin. So that's like one flavor of stable coins. There is some adoption, but honestly, not too much. Algorithmic stablecoins, for those of you who are paying attention to the crypto space in the last couple of years, probably heard about Terra, which had a historic run-up and an even more historic sort of crash when Terra's stablecoin kind of completely imploded and lost its peg. Here, the idea is that, like, there is no collateral, but the idea is you do some clever financial engineering, which is supposed to ensure that the price of a stablecoin never moves away from the peg, right? Again, very risky, I would say very cutting edge in terms of how some of these are thought through, but none that has scaled significantly. And then you also have what are known as commodity-backed stablecoins, right? So, for example, you have PaxG, which is a Paxos gold stablecoin. It's actually not mimicking a dollar, but it is mimicking some unit of gold, right? I think today, if you look at it, one PaxG is like $4,000, and as the price of gold fluctuates, this also fluctuates in tandem. So yeah, that's kind of the map of different types of stable coins. But again, when you look at popular stable coins, particularly in the payments context, you actually see that the top 5 stable coins, if you look at them from a value market cap perspective, firstly, the interesting thing here to note is that today stable coins have crossed like $300 billion, billion with a B, in market cap. So from a pure size perspective, they're massive. What's also worth noting is that most of the value here is actually in USD denominated stable coins. We have sort of put on the slide like the top 5 stable coins that you see here. Again, within this also you see most of it is today with Tether and Circle's stable coins, but actually this is sourced from this website called DeFi Llama. And if you go and look there, there's actually like close to 300 stable coins, right? So the number of stable coins, the different attempts at design here is actually today really wide. And maybe one thing I wanted to particularly call out here is a lot of people think stable coins are only pegged to like dollars, but there's actually there's a lot of interest and a lot of exciting developments, particularly in the Asian context, happening with local stable coins. And what these are essentially is very much like USDC, USDT. These are attempts at building like stable coins that are pegged to local currencies in Asia. So IDRX in Indonesia, Blocks is a company that develops MYRC for Malaysia. Similarly, you have attempts at PHPC. Some of you might have heard of StraitsX. They are building like the XSGD for Singapore. The difference is that the regulatory framework here might be a little bit nascent. It's still like in early days in Asia, but very strong attempts. We've actually met and worked with a lot of these teams as well. extremely strong teams. And so like our house view is that this is a very bullish category, and we expect like, a lot of growth to kind of come from local stable coins in the coming years. So that's kind of the first section, and hopefully it give us some overview on like, the high level of stable coins. But I think the important question which a lot of people, especially from the payments world, have is that, hey, like, payments work pretty well today, right? So why do we need like stable coins, and how do they really like improve upon today's payment rails? And you might have heard some of these things being thrown around, right? Hey, that stable coins have programmability, or the 24/7 settlements and so on. So kind of wanted to unpack some of that with you, that what is kind of the difference between like, traditional rails versus stablecoin rails in the context of payments. We'll look at other use cases later, but just payments, because that's sort of top of mind for everyone. What are really the differences, right? So maybe just going point by point here, for all of you who are familiar with, like, let's say how US payments work, and this is true in a lot of markets which don't have real-time payments. There are typically like, when you're using traditional rails, there are like these cutoff times where if RTGS order or ACH order is put in after that particular period, it only actually gets processed the next business day, right? Stable coins, on the other hand, have no like on and off times, because blockchains, they run 24/7, they operate globally everywhere. And so what that means is that you can actually do transfers at any time. And also the beauty of blockchains is that the moment a transaction gets sent, as soon as the next block gets finalized, which typically is a matter of a few seconds to a few minutes in worst cases, that is also considered as the transaction being settled, right? So initiation to settlement can take sub few seconds also in some cases. And so while you have bad settlements and slow like T+0, T+3 settlements in the fiat world, what that translates to in the stablecoin world can be a matter of like seconds, right? And I think from having spoken to a lot of people in the payment space, this is really like the most important feature of stablecoins for them. A close second, I think, is also the fact that because traditional rails depend on and rely on a lot of intermediaries, and every intermediary comes with their own sort of fee in the middle. Cross-border transactions, especially those from let's say, G20 geographies, incur like high fees, both on collections and payout side. But again, here, because you're removing the number of factors in the whole process, fees using stablecoins typically ends up being like significantly lower. Right? So that's the second benefit you hear often. The third thing I think is also very important to call out is sort of similar to the first point, worth noting that a lot of the ways in which traditional payments operate is you have these payment networks in every country, and SWIFT is sort of the rail that's connecting them. Here, there's an inherent aspect of borderlessness in stablecoins, in the sense that stablecoins only understands the concept of addresses and not like geographies and borders in the traditional sense, right? So you can actually transfer money instantly across borders. Of course, converting them into local usable currency, fiat currency, is a different matter, and we'll come to that. But stable coins per se are borderless. And then, of course, we have the other things like, there is a lot of programmability that being a cryptocurrency offers, which inherently comes with stable coins. And here's the funny thing, right? That a lot of people think that when things are happening in the crypto world, they're actually like opaque and they're like, not auditable. But the reality is that today's public blockchains are actually entirely like, for lack of a better word, like not private. Every transaction that gets happened, the entire trace of who the address was, when did they transact, who did they transact with, is all auditable and available on like, public blockchains. And so from that perspective, ironically, actually using crypto makes like transactions and payments much more transparent and auditable. And if anything, there's actually a counter movement that's happening right now, which is talking about how transactions, especially for payments, should be private, right? And there's a whole movement for privacy with stablecoins, but that's maybe for another day. So that's kind of the ways in which stablecoins are differ or are better for payments. And maybe just also showing this in a visual sense, some of you have probably heard of this term called stablecoin sandwich that gets typically used in the context of in cross-border transfers. So this image kind of shows how a traditional payment would work, cross-border payment would work in the existing world, where let's say you have a flow from a US bank to a Mexican bank. You have the SWIFT network that gets used. In this case, there's one correspondent bank, but in some other cases, maybe there's 2-3 correspondent banks that have to be hopped through. and that's what adds fees. That's what adds increased settlement time. But if you do this through stablecoins, the stablecoin sandwich essentially is like a three-step process, no matter where you are, where the first transaction is what is known as an on-ramp transaction, where you typically go from your local fiat currency to a stablecoin. Then you have a transaction which is happening on the blockchain, where the sender is sending USDC or USDT to the recipient. And then finally, you have an off-ramp transaction, where the recipient is then converting the stablecoins into their local currency. Right? So in a sense, the effect is still the same. You start off with one fiat currency, you get to another fiat currency in a different geography, but the model is significantly simpler when done through like stablecoin rails, right? And what does that simplicity actually mean? Is some of the things that we kind of just discussed, right? Like, why are people using stablecoin for remittances? Why are people trying to use stablecoin for, let's say, export import and other categories of cross-border payments? Is things like T+0 settlement. And no matter where you are, as long as you have the on and off ramp that can happen on the same day, you can essentially do T+0 settlements. Geographies such as emerging markets, especially where collection fees, payout fees can be like 3-4% upwards, you can significantly bring those down, right? Like to less than 1% fees. And the thing that I hear a lot from PSPs and other payment folks that we talk to is that the biggest thing that stablecoins have solved for them is that from an enterprise perspective, it has removed the need, or it can remove the need for pre-funding. Right? Like for those of you in the space that you'll know that if you have, let's say, operations across 10 different geographies, you not only need to have partnerships with local payout partners, but you also need to anticipate demand. You need to prep for weekend demand. Even if you have actually not received that money yet, you need to pre-fund your partners to see through the flows there. But in the case of stablecoins, now what you can do is everything can be real time, right? As in when you have requests for payouts, you sort of fund in stablecoins and payments happen real time. So that's kind of why you see that one of the biggest themes today with stablecoins is basically cross-border payments. Beyond this, beyond cross-border payment, there are a lot of other use cases too. I'll keep some of these at a pretty high level, but there is, talking to enterprises, we realize there's a dozen or more use cases that people are currently exploring. But some of the ones that we hear most often, maybe to just cover them. One, and this is, I know it's a very tricky one, but stablecoins are providing some sort of call it financial stability, or call it dollarization or currency hedge in places where there is either volatility of local currency or lack of trust in local systems, right? And we see this a lot in, let's say, markets in LATAM, markets in, let's say, Africa, where a large part of the population today actually holds USDT. They transact with each other USDT, and there's a big market of P2P, right? Where if you go to some of these countries like Egypt, you can actually pay for your car rides using USDT. You can go buy stuff from the local market in USDT. So there's a very natural, strong product market fit that has already existed in the last couple of years. And now there are people in the last year or so who are trying to build better products, add crypto cards and so on top of this. Obviously, it is I said it's a tricky issue because local governments don't like it, and it's yet to be seen how some of this stuff pans out. But strictly speaking, if you talk about it from a value perspective, this is probably, after payments, the largest use case that you see today. Then you also have the idea of stablecoins removing geographic barriers and enabling a financial system which is more borderless, which is a bit more global, right? So what I mean by that is, today, if you look at opportunities for yield that you have in existing systems, typically it's very hard to invest in systems outside your geography, right? So example, as Indian residents, it was very hard until recently to, let's say, buy US equities, right? Or if you relied on, let's say, government yield, treasury yield, it was limited to the country that you were in. But what stablecoins does, and now you're seeing increasingly that all these other asset classes are also getting tokenized. They're also coming on chain, and having stablecoins is allowing you to get access to yield across these different products. So this is again a big use case that we see. Again, of course, goes without saying that regulatory aspects here are very important, and they're in different phases of evolution. But a story that we hear often is people want to access yield from various markets. And the flip side of that is also that when you are a small business, when you want to let's say get credit, this is also something that has traditionally been challenging in local markets. But there are, let's say, people who have access to capital, who have a certain risk appetite, who want to invest in and get access to such markets, right? So there could be investors in the US who are interested in, let's say, giving credit to small businesses in, let's say, Africa or the emerging markets. And there are a bunch of like products which are using stable coins and sort of building out this marketplace. So that, I mean, what you would call as like like a more global financial system is something that again we're seeing getting built through stable coins. And finally, I think the other big use case that we are seeing, particularly from a lot of corporates, from a lot of people who have global treasuries, is that stablecoins allows you to have a significantly simpler treasury management process and use your reserves and liquidity more efficiently. And so similar to the idea of cross-border payments, now instead of having, let's say, treasury kept in 10, 20 different countries, you can have almost like a global USDC balance stored in one place and then sort of like, use it when you need to across these different markets. And when you need to move funds, happen instantly, right? So you can kind of bypass Swift and existing systems. And overall, it's seen as like, way to optimize your treasury, optimize your payouts. So this is again another theme that we hear often. But again, as I mentioned, there's a variety of use cases beyond this, but yeah, we just wanted to keep it sort of high level here. Okay, so moving on to the next section then. So we looked at like why stablecoins are better and some use cases. What exactly is the stablecoin stack, right? And I think this is extremely important for any of you who are considering adding products to your companies or like, in general, been talking to like other partners in the space. Because stablecoins are built on crypto rails, they come with different sort of technology and sort of business stacks as compared to what you might be used to in the Web2 world. I think the first and most important one here is the idea of a wallet. Right? For those of you who were joined early, and I mentioned that we were also building like a crypto wallet. This is the business that we were in. But essentially, the idea is that stablecoins, because they're a cryptocurrency, need to be held in a particular wallet. And you see a variety of flavors here with respect to how these can be held. I'm sure all of you are familiar with exchanges like Coinbase, Binance, which are what are known as custodial exchanges, where you can hold your stablecoins in. But there is an entire world of non-custodial products, this kind of where we operated, where you have wallets like MetaMask, Phantom, which allows you to like hold the stable coins. You also have Ledger and other like, cold wallets allow you to hold your balances. And now you're also seeing a little bit of evolution where you have experience for the user, which feels like I just sign in with Google, I just sign in with Facebook. But under the hood, somebody is doing the heavy lift of creating for me like a hot wallet, right? So it doesn't feel to me as though I have to go and create a wallet. But essentially, I think the important takeaway from here should be that no matter what solution you use, at the core of it, there needs to be like a particular wallet that is holding funds for the user. And this sort of becomes like the first primitive in the stablecoin stack. Next, you have what are known as on-ramps and off-ramps. And these are, again, extremely important parts of the stablecoin world today, because the assumption that we're making is that both sides of the transaction, typically the sender and the receiver, ultimately wants to sort of settle and hold balances in fiat. Right? Until this changes, and maybe like 20 years later, people are comfortable just sort of living in a stablecoin economy. Today, people still want to like, withdraw money to like fiat. And hence, on and off ramps provide the critical infrastructure of being able to go from your fiat currency into stablecoins, and then stablecoins back into fiat currency. Usually, the same providers end up offering both, but in some cases there might be differences here. And importantly, this is where a lot of the regulations and regulatory licenses sort of come into play, right? So for people familiar with, let's say, the Singapore market, you must have heard of AAA, Independent Reserve. You also have folks like Transact and the huge list of people here who sort of have the requisite licenses to be able to sort of move money in and out of stables. And for the more institutional, I'd say large volume use cases, what will happen sometimes is that the issuers themselves, like in this case Circle, will allow large institutions to have an account with them. So rather than even going to a third party, you could just directly natively go and mint and burn from Circle. But essentially, the idea is the same, that Circle Mint also is technically an on-off ramp, which allows you to move between stable coins and fiat. Right? So far,
Sorry, Sanjeev, just to pause you here. For everyone's benefit, I've mentioned the Slido link where you can ask questions. And Sanjeev, if you can complete the main content in the, let's say, next 8 to 10 minutes, so we'll have about 12, 13 minutes for the questions as well. I think we have about 10 to 12 questions already.
Awesome. Yeah, let me try to like breeze through that a little faster then. Perfect. So we spoke about wallets. We spoke about on and off ramps. The last layer, critical layer, is then the actual blockchain itself, right? So the blockchain is actually where the transaction happens. So when we say a sender sends X amount of USDC to the receiver, that is what is known as an on-chain transaction. As I mentioned earlier, it happens on the blockchain, gets settled immediately. And this is where you have a whole variety of options, right? You've probably heard of Ethereum, Solana, Tron, Polygon, whole set of blockchains where people can transact. Interestingly, in the last little bit, you're also seeing stablecoin first chains come up. So folks like Plasma, Tempo are trying to build purpose-built networks, as they call them, specifically for payments. So this kind of completes the third leg. And so going back to the same transaction that we looked at, when we said, hey, there's a bank account in USD that needs to transact with a bank account in Mexico. Now you can see how the sort of key components come into play here, where you have the on-ramp transaction that puts USD into USDC in like an actual sender wallet. Then you have the blockchain where the transaction actually happens, the cross-border transaction actually happens. And then finally, you have the off-ramp transaction, which moves the money from the receiver wallet back through an off-ramp player into their bank account. Right? So this is sort of the crux of how a stablecoin transaction works. But the reality is that if you look at the actual stack, as you would imagine, where there is such big opportunity for impact, there are a lot of layers. Similar to, I would say, in some sense, what you see happening in the existing sort of Web2 payment stack, where you have applications, payment gateways, orchestrators, liquidity providers. Right? In the interest of time, we'll skip through it, but sort of you can draw a good mental model from what happens in the Web2 world to sort of what happens here. And this is what sort of completes the entire stack, right? And particularly, since a lot of our audience is from APAC, if you look at what does the stablecoin market look like in APAC, you have a whole variety of API providers, OTC providers, PSPs, orchestrators, who are all trying to solve different problems in one or more geographies in sort of the space, right? And what I have on the slide are some of the names that you guys are familiar with. And they're all, from talking to all of them, I know there are different stages of where they are in their stablecoin journey. And if we can make a quick plug for Sentra here, this is sort of what we do, right? Like what essentially we are trying to do with Sentra is become like an orchestration layer for APAC, which means that we take all these partners that we've discussed for APAC, we kind of put them into one umbrella, we put them into one API suite, one network, whether it is for on-ramps, whether it is for off-ramps. And then we offer this out of the box to any enterprise that wants to do stuff with stablecoin. So let's say you're a remittance company, you're a PSP, an export-import player. If your workflow involves stablecoins in Asia, then we'll probably have the simplest set of APIs for you to be able to make a transaction, right? And what that means is essentially you get capabilities to do collections, you get capabilities to do payouts, virtual accounts in a variety of these. And so this is just like one example of providers. So again, there are like other orchestrators like us, the liquidity providers. Yeah, maybe we can do an entire session on what the stack looks like. But in the interest of time, quickly want to move on to the last section, which is around like stablecoin adoption, right? Again, there are tons of metrics that people in the space talk about, but the long and short of it is that no matter how you slice the data, whether you look at it from the number of active addresses that hold stablecoins to the amount of just the dollar value that is being settled to stablecoins, it's always like an up and to the right number, right? So there's no denying that, especially in the last 2-3 years, we've seen a significant sort of surge in stablecoins. And again, because a lot of you come from like licensed payment companies, you'll see that the biggest hurdle up until now, at least, has been that regulatory clarity was still sort of emerging, right? But the interesting thing is that this is suddenly in the last 2 years taken a big turn. And if you look to the chart on the right, this was like a 5 blocks survey that was done, where they noticed that between 2023 to 25, a significant improvement, I think the sort of labels got cut off here, but the significant reason for adoption is coming from the fact that a lot more confidence in the regulatory regime. And this is from some of these names are probably familiar to you all, like the Genius Act in the US or the MiCA regulation in EU, which is essentially giving legitimacy to different kinds of stablecoin issuance frameworks, different kinds of virtual asset frameworks that people can then sort of build on top of. Is that the only challenge for stablecoin adoption? I would say definitely not. There's a variety of other things that you've seen in the space, right? And today we spoke about on and off ramps, and when you go and talk to big players the likes of Neum and stuff, the biggest challenge that they'll bring up to you is that although we talk so much about stablecoin benefits, the fact of the matter is that the liquidity is largely limited, and for any player that is looking to move size, you realize that there is limited depth in the markets. So big problem that a lot of smart people are working on. Compliance is still a very big issue in the space, right? I know from our own conversations with a lot of different folks that the typical dynamic that we see is that the business folks want to get the transaction across the line. They're really excited by stable coins, but compliance teams are still sort of getting comfortable, right? And it's sort of bringing them on board. That's a slow process, and rightfully so, because they want to make sure they are abiding by the laws of the land. And lastly, UX and security, because we're talking about stable coins and we're talking about all these new things like wallets, which don't necessarily belong in your existing applications. Adding them in a way that is not confusing to users is probably also what we're seeing as one of the issues. But again, all of these things, from being in the space and building here for a while, we know that they're getting worked on, right? Really smart set of people working on all these problems. And finally, just wanted to talk about some examples, because this is sort of what all of you have probably also seen in the space. This is what has brought a lot of clarity and interest in the space, seeing such big names here, right? So for example, many of you might have heard about the fact that Stripe seems like Stripe is kind of going all in on stablecoins. They acquired this company called Bridge, which is a stablecoin orchestrator in the US, right? Rumored to pay like $1 billion plus for that transaction. Then they bought another company that builds wallets called Privy for 500 mil plus rumored amount. So clearly, Stripe, which is one of the most respected fintech players, is going all in on crypto. Similarly, for those of you who are also on the issuance side, you probably know that Visa and MasterCard are also doing pretty aggressive pilots with stablecoins. A lot of them now allow payment processors to settle natively in USDC, USDT. A whole bunch of examples, but maybe just a few more notable ones is like Shopify today has added a native integration with Coinbase and Stripe, where Shopify merchants can accept stable coins. Circle, a company behind USDC, had probably one of the most successful IPOs in recent times, right? And then in terms of the number of people who want to launch their own stablecoin, I guess there's you could fill a couple of slides here, right? Everybody from Fidelity to Bank of America to the biggest banks in the world, trying to figure out how they can get to their own stable coins. So this is probably a lot of what you guys have seen. For us, from our perspective, one of the very interesting use cases that we've also seen is crypto cards, where essentially crypto cards are actually making way for that mass retail adoption, allowing people to have a balance in USDC, USDT, but solving the problem of distribution by almost like allowing these balances to be used across any Visa, MasterCard network by treating them as USD balances. And the fact that Visa, MasterCard are allowing native settlement to stablecoins makes this significantly easier, right? So this has been like one very interesting vertical in recent times. And finally, I think the last thing that we're seeing is a very interesting dynamic here is everyone wants to launch their own stablecoins, because there's also a very attractive stablecoin yield component, where traditionally the way Tether and Circle operated is they collect USD from you, they sort of deposit them in short-term treasury yields, and they get to keep all of that profit, right? So for example, Tether is probably the most profitable company in the world by a number of employees, because it's just a very straightforward business model. But now what people are realizing is that if you are somebody who actually is bringing users, who's bringing transaction volume, then why do you need to rely on somebody else's stablecoin? You can kind of have your own stablecoin, and then you kind of get to keep a lot of that yield or all of that yield, right? And so there's a whole emerging sort of business verticals around people who let you build your own stable coins and do different things with it. Again, we probably don't have time to go into all the details, but Dakota, Hyperliquid, and a bunch of very interesting examples in that space. And so yeah, with that, we'll call it a wrap. I mean, last couple of closing thoughts here is, I think from your perspective, like how should you think about stable coins? So I think one, I definitely think it is a time to be like curious about the space. And thank you all again for showing this curiosity and wanting to be here. Like it or not, I think stablecoins is going to become a force in the payment world. And like taking time to educate yourself is absolutely the way to go. Second thing I want to add here is like, I feel like folks like you from the payment space are people who can help us bridge the crypto world and the payments world. Like we understand crypto, you're new to payments, is vice versa. So I think we can sort of jointly work together to help stablecoins set up. And lastly, I think a lot of people I talk to, a lot of you are also people who are good friends with regulators, people locally. And I think you guys can play an influential role in shaping policies, which can help us with stablecoin adoption, right? So yeah, I think a bunch of stuff that we can do together. And yeah, thank you all so much for being a great audience. Vishal, I think we have enough time for questions.
Yes. No, thank you so much, Sanjeev. Really awesome. I think it is, I guess, when Swift, etc., started, a lot of people had a lot of questions and there was so much unknown. But one thing I'll correct you, Sanjeev, we treat crypto guys as part of the payments ecosystem. So please don't go away, right? We are the same. We are not different. It's just that we have a different set of knowledge and you have a different set of knowledge. And we are glad to have you with us. So I'm going to present the questions on Slido. And you can start picking them up. I won't be orchestrating the questions, Sanjeev, so we'll leave it to you to kind of do that. There you go.
Sure. Just give me 1 second, Vishal. I'll just get this up on my screen as well. Perfect. Yeah, I mean, we can try to go through some of these in the same order, actually. What do you mean when you say there's Tether on 90 plus chains? So is it similar to stock being traded on multiple stock exchanges? Great question. I think the idea is that, when a stablecoin is issued on a particular network, basically think about these networks as different countries, right? There are ways in which you can connect these different networks, but ideally when you're making a transaction on a particular network, it doesn't understand a concept of something outside this particular network. And so what issuers like Circle and Tether do is that they have sort of native smart contracts on each of these chains that allow them to deploy like USDT natively on each particular network. Of course, there are ways in which you can what is known as bridge USDT from one network to the other. And honestly, this is one of the biggest problems in crypto, that because there are so many networks, there's a lot of noise around different wrapped versions, as they're called, of these assets. But when you have native issuance, it kind of solves a lot of that problem, right? And that's why you see Tether and Circle on almost all major chains, they'll have Tether deployed. And so when you look at the total market cap of Tether, it is basically a combination of that USDT being held across a variety of different chains. Cool. Then you have a question from Vishal. So cryptos get minted. Do stablecoins also have to be mined? Sorry, mined, not minted. Yes. So essentially, I think, Vishal, here the thing is that while Bitcoin would get mined, the right word that used in the stablecoin context is usually minting. And so what minting is at least in the concept of a fiat collateralized stablecoin, you go and deposit $100 US dollars, and then you mint $100 worth of USDC. Right, so that is sort of how the peg also eventually gets maintained, and the reverse works too. You can go and ask for 100 USDC to be burnt, and that allows you to redeem back $100. Yeah. What advantages do stablecoins have over fiat? Is it solely the use of blockchain as a ledger? I would say yes, because ultimately, if you think about why use stablecoins, the benefits come from the fact that, let's say, blockchains allow you to do instant settlements, right, which are not possible in the existing fiat world, which uses, let's say, a messaging system like Swift. And so the moment you start talking about like private blockchains and start talking about other use cases, you automatically lose some of these benefits. So when we think about stablecoins, for us, stablecoins issued on public blockchains are sort of the biggest use case, right? How does a company come up with this USDT, USDC, USDP? I'm not sure I understand this question, but if the idea is that how do you as a company get access to these currencies, variety of ways to do it. Typically what could happen is you could, as a business get a corporate account with an exchange like Binance, Coinbase, or so on. You sort of KYB with them, come on board, and then they allow you to, let's say, deposit fiat and get some of these currencies. It could also be that if you could work with some of the other providers we mentioned, and then they have more like programmatic flows where you might be sort of, as example, Sentra would use APIs from some of these providers, and then we can help you do this on a per transaction basis. So it depends on the use case, but there are API providers, exchanges, OTC desks, a variety of methods that would let you do this. Yeah, so how can fiat be converted, stablecoins be converted to fiat? Question from Shubham. It's exactly the same way that I mentioned. So you can have, let's say, if you are a big institution, you might have an account with Circle, and Circle will let you burn USDC, receive fiat. If you are an individual or if you're a smaller business, you go to an exchange, crypto exchange lets you do that, or you use products like Sentra, or you use AAAs of the world, and all of them will have some capabilities to move on and off ramp. One thing I would like to call out here is that, and sometimes people don't realize this, that this is not free, right? There is a small amount of fee associated. Typically, on ramps don't charge money, or they charge less money if it is USDC to USD. Sorry, vice versa. But USDC to USD, right, or USDC to HGD, transaction like that always come with a small fee. I think one of the things that people are trying to also work in the space is how do we bring this really down to a minimum, right? But there is some fee here. Data on cryptocurrencies and stablecoins, I think we covered this. But one thing I do want to call out is just being the devil's advocate here. The number that we spoke about, right? 27 trillion in volume, 80 million in wallets that hold cryptocurrencies, stablecoins. A lot of this also does come from crypto activity, right? A lot of this comes from people who are trading crypto, institutions that are moving and market making in crypto. So it's not all payments. I would say payments, if anything, has been a major theme from the last 12 to 18 months. But we know from talking to a lot of partners that we work with, where volumes have just gone up exponentially. Right? People who are processing 10 to 20 million in payments are now at 300 to 500 mil. Everyone's seen for a good player, you've seen 10 to 20x sometimes in the last as little as 18 to 24 months. So definitely the use of stablecoins payments is definitely growing. Yeah, this I think is a great question. If stablecoins need all these infrastructure, aren't we just replacing banks with new intermediaries and frictions? I would say yes and no, because today we are at a point where we are trying to use the benefits of stablecoin, but still live in a world where you believe that people want to go back to fiat, right? But a lot of the work that is being put together by the likes of Circle, Tether, even companies like ours, is that we believe in a future where people would just hold their funds in stablecoins. Right? The problem happens where if you say that every transaction needs to be sort of in fiat, is when all these pieces of friction come in. But if you believe in an economy where, let's say, you're able to comfortably receive and send payments in stablecoins, then imagine a business which keeps working capital in USD. Tomorrow, you might just keep your working capital in USDC. And apart from a small amount of profit that you want to book and bring back to fiat, all of it is probably in stablecoins, right? And that then takes away a lot of the complexity that we see today. Yeah, another great question around what with stablecoins, what are the regulatory requirements in place? This is a very complex question, and I think this depends entirely on geography to geography, right? The way US treats stablecoins versus Singapore versus Vietnam is completely different. Almost in every market, you see that regardless of the regulatory clarity, there is a lot of sort of usage, right? Now, I think the usage, typically the patterns that we've seen is that typically usage is bottom up, where you see a lot of businesses and individuals starting to use things. And that's when local regulators realize that, hey, there is actual demand for this. And then they try to come up with their own frameworks. Sometimes the framework ends up being friendly. Sometimes it can be net negative as well. But the unfortunate answer is that it's extremely dependent on each geography. Yeah, again, another great question about how do you see currencies achieve on-chain effects? So this has been something that's honestly been an open question even for us. And we also don't have a clear answer that there are two ways in which you can imagine the stablecoin sandwich that we spoke about, right? That one is you imagine a world where there is liquidity pairs tied to USDC or USDT with every local currency. So you have Naira in Nigeria, PHP in Philippines, and so on. And all of them, they're local players who sort of hold USDT to Naira, USDT to PHP liquidity, and they become your counterparties. Or the other world that people are trying to imagine is a world where every local currency has an equivalent stablecoin, and the actual FX transaction is happening on chain. So then the idea is you mint and redeem 1:1 in local currencies always, and the trade itself, the FX swap happens on chain. Will that be cheaper? When will that happen? What will the dynamics of that be? Honestly, I don't know. So whoever asked this question, if you have any thoughts on this, it's been an open question for us as well. So we'd love to learn more and chat with you. Are the fees for on and off ramp cheaper than traditional settlement flows? Yeah, great question again. So as a reference, right, like on ramps in a lot of markets are actually free because companies like Circle, they want to incentivize you to come on chain. So if you're an institution that you go and mint with Circle, they'll actually do USD to USDC completely free. USDC to USD has a fee, right? Now, this depends. What we have seen is if you are, let's say, a small business or individual, you might pay as much as 20, 25 bips for this transaction. But if you're an institution with size, you might be able to get this down to like 2 to 5 bips as well. Right, and we're talking purely about USD, USDC. When you obviously, if you want to do USDC to SGD and so on, then there's FX also that comes in. So as I mentioned earlier as well, it's not zero. There is some amount of fee, but a lot of attempts at trying to bring this down to lower. What cross-chain bridges would you recommend for lowest percentage? I mean, our preference usually is, and that's what we've done in our previous wallet product as well, that we try to go with aggregators. So there is an aggregator called Jump Exchange, probably the best right now. So when you go to them and you try to bridge, they actually aggregate various bridges and they will show you like fees, settlement times for all chains. So that's probably the best bet here. Yeah, Vishal, maybe we have time for one more question.
Actually, it's quite awesome. We had totally 52 people join, and we still have 48 left, which means people are hooked onto this. So I would say if you have enough time, we can go ahead, and if you don't, then we'll send the questions to you.
I'm good
So let's spend another 5 to 7 minutes to answer the questions as much as we can.
Sure. Can do that. Do we foresee consolidation in the space prior to mass retail adoption? Yeah, this is an interesting one. I mean, what's happening right now is there is so much interest in the stablecoin space that like every day there are new startups that get funded, new startups that claim to solve a problem here. It is our strong belief that there is going to be consolidation, and a lot of this consolidation is probably going to happen from traditional payment companies, traditional enterprises that will kind of go and buy up these small companies, right? Because they all want part of that pie. But eventually, it doesn't make sense to me that there are dozens of orchestrators, dozens of license providers. Inevitably, there is going to be some consolidation that happens here. And again, as it happens in the payment space, those who have access to distribution, those who have access to capital, are the ones who are going to win this. Yeah, are local stablecoins similar to CBDCs? I would say no. Because ultimately, the idea with a local stablecoin, let's say take an example of MYRC, we're trying to work with the blocks team that runs it. The idea here is that the blocks team is going to issue the MYRC token on a public blockchain like Ethereum, right? And hence the idea is that once MYRC is issued on blockchain, it has the same properties as, let's say, USDC, which is that it can be transferred between any two wallets anywhere in the world. But if it was a CBDC, then typically the way the regulator will look at it is to say that they wouldn't maybe want it to cross a particular geofence, or if it is crossing the geofence, they would have certain rules around how it happens. So I would say there are significant differences between local stablecoins and CBDCs. We haven't looked deep into the regulations here, but I do know, for example, that Singapore has an MAS framework for SGD stablecoins. Hong Kong has a local framework. So yes, there are efforts to regulate local stablecoins, but they probably look very different from CBDCs. Yeah, I think another great question from Shubham, which is that from the minting process has to rely on the fiat system. So how do you how do you kind of make it real time? So I think there's two things to think about here. One is that a lot of markets in the world actually independently have real-time payment systems. So, for example, India has UPI, EU has SEPA, and so on. So the problem is that individually all these geographies have real-time payments, but it is the SWIFT leg that was slowing things down. So straight away in these sort of scenarios and corridors, this is no issue at all. The problem happens when on one side you're dealing with a currency that has these traditional ways, like US is a great example where ACH, wire transfers depend on business hours. So in that case, how people are solving this problem is that there is a new class of products which are kind of complementary to what we are building at Sentra, where they issue you USDC as a short-term loan, right? So essentially how it works is, let's say on a Friday evening, you initiate a ACH transfer. They would basically get some transaction receipt and say, okay, you are initiating a payment for $10,000. Here is 10,000 USDC that I'm issuing you, and you need to pay me back on Monday with a certain interest rate, right? So there are people who are trying to kind of like circumvent this system. But I think in most currencies, in most places where there is RTPs already live, this should actually not be an issue. Charges for on-off ramp, yeah, I think we already covered this. FIU India send notices. Yeah, so interesting question here. So when it comes to like fiat to INR flow, how we sort of have our network set up here is that there are two ways to do this. One is a method where you can actually do the off ramps outside India. So essentially, it's like, maybe an off ramp happens in the US or in Dubai or Singapore, and then the last mile happens via fiat rails, right? This makes sure that you get your FIRC and it's happening in a compliant manner. Or we also have local partners in India who can support like local off ramps. So we sort of don't try to take a point of view on that. We support like both methods. Ultimately, it's a function of like what your use case is. We are, and just to be clear, with Sentra, we are not in the flow of funds. So we are an aggregator. We bring together providers with you as a business or merchant with the use case, and then it's up to like your risk tolerance, your use case, and what the provider needs to decide whether like to do this transaction or not. Yeah, what is the role of stablecoins in financial inclusion in places with unstable currencies? Yeah, great point. This is something we covered in the slides as well. The biggest sort of like right now, if you look at a lot of markets in like Africa, right? USDT has a crazy amount of penetration without anyone having done something, right? It's not like Tether has gone and spent a lot of marketing dollars to do that. It's just very bottom-up organic adoption where businesses and individuals both prefer holding USDT to holding like local currency. And there's a whole economy of P2P transactions that is built up. Now, of course, there are people who are trying to make that a bit more sophisticated. The biggest question, of course, here is that no economy, no country would effectively like their sort of individuals to be dollarized, right? It takes away power from the local governments. So that's sort of the biggest issue. We're already seeing this happen in some places where, let's say in LATAM also, if I'm not mistaken, there are some places where there's a limit on how much USDC an individual can hold. Right? They're more relaxed on business payments, but for individuals, there's a certain limit on holdings and transactions per month. So I do imagine like, sooner rather than later, these sort of regulations will definitely come into place. Cool. How do the off-ramp work? Yeah, so with respect to off and on-ramp transactions, they are both sort of places where you are touching fiat money. And so these flows are always like they're always sort of like KYB, KYC flows. We also at Sentra only work with partners who have local licenses, and so depending on the license that the partner has and the regulatory framework in that country, there would be requirements for KYB. There would be like AML checks, wallet addresses that are being checked. So there's all kinds of like behind the scene compliance checks that have happened. Some from our end, some from our partners. And every person who wants to even come on board has to go through like a rigorous onboarding process, which again changes from geography to geography. Yeah, great question on like stablecoin versus CBDC. What is the use case price difference? So as I covered earlier in the slide, they actually, because they're both sort of coming from the same concept of digital currencies, they offer a lot of that same promise with respect to programmability. right? So, for example, whenever you hear CBDCs being spoken about, the way it is being pitched is something like this, right? That like, look, if let's say somebody is living on welfare and they are receiving money from the state, you don't want that income to be spent on, let's say, like, liquor and gambling. And so the moment like money is digitized and you have the idea of programming, you can think about it this way, that instead of having one wallet, you now essentially have like 10 wallets, right? 10 wallets, micro wallets, and each wallet you can set the rules. You being the government or the bank can set the rules on how that money gets spent. So you can say that any money that's coming from welfare sits in this wallet, and that can only be spent on, let's say, food, right, or education. So that's like the good use case, I guess, of it. But the flip side of that also means that now every single thing is sort of under the watch of some centralized actor, right? And so then are we sort of going to a world where, like, the amount of, let's say, discretionary money we spend on entertainment, on liquor or anything is going to be also controlled? That is what, like, the people who are against CBDCs will talk about. But they do come from sort of very similar concepts of programmability, so to speak. Yeah, if PYUSD is cheaper on, I'm not sure what it's on ERC sold. Okay, right. Okay. So the question here is that, like, if PYUSD, which is a stable coin from PayPal, it's cheaper to off-ramp it on certain particular chains like Ethereum and Solana directly, then why can't we off-ramp it using those as opposed to routing it through USDC or USDT? So here's where, like, one of the bottlenecks that we've also run into while building Sentra is that ultimately the license provider is the person who has the liquidity, right? They are a counterparty, so they need to have liquidity for, in this case, PYUSD to, let's say, PHP. And what ends up happening is that if they don't have liquidity for that, then what might need to happen is someone, which is, let's say, us, might have to do like an on-chain swap where we convert PYUSD to USDT or USDC, and then USDT or USDC is exchanged with PHP because that's the pair that the local provider in the Philippines has liquidity for. So usually the limiting factor here is not the on-chain token, but the liquidity that is available with the local provider. Yeah, next question is around Sentra's global USD accounts. Can it be used to settle directly with partners on the same bank network, or does each partner need separate banking rails? So the way we've orchestrated the global USD accounts is that, think about the global USD accounts are nothing but USDC balances, which effectively for you, for a business or for an individual, is like a certain amount of USD that's sitting in there. Now, when you want to settle it with a partner, there are a variety of methods that we offer in. Let's suppose that you have a partner that's willing to accept it directly in stablecoins. You can kind of move from your Sentra account to, like, let's say, their on-chain wallet, which I know is a small use case today. But let's say they want payments in fiat. What we've done is we have a variety of local payment partners, not just in Asia, actually. We've extended it to like US, Europe, Africa, other markets, where you can use this like USDC balance, which is in your global USD account, and straight up make payments to your vendors in EU, let's say your contractors in the US or anywhere else, right? So we do support this. Of course, there is a lot of complex piping that happens under the hood, but that is not something that the customer needs to worry about. We've kind of taken care of that at our end. Banking coming with tokenized payments. Yeah, unfortunately, I'm not sure what tokenized payments are, so I don't want to, like, make up an answer here. So I'm probably going to skip this. And then last question around like INR-backed stable coins. There is chatter. I'll say for sure that I've heard multiple people bring up INR stable coins. I know this is a little bit also flying under the radar because of crypto regulations in India. People don't like to talk about it. Again, there's no specific names that I've heard of, but from ecosystem sort of builders in India, I've heard that there are efforts that are coming up. We are also excited to honestly work with folks like this. So yeah, if anyone knows INR stablecoin builders, we'd love to chat with them. Awesome.
Sanjeev, I think you should probably share this internally and say that you had one mammoth record session and people stayed till the end. So thank you so much, everyone, for for joining the call, and let Sanjeev share his piece of information. It's very fascinating. I can say that I still don't understand it, but I'm sure if we look at the recording again, we'll be able to kind of do that. So thank you again, and anyone who wants to reach out to Sanjeev, he's part of the Payments Club. I've tagged him in the last post, and he runs the company called Sentra. So you can reach out to him. I don't know what use cases everyone has, but thank you again. Really appreciate you spending time with us.
Yeah, and quick thank you from my side as well. You guys have been a great audience. I think some of these questions that we got are also like pretty involved. So I didn't expect some one-on-one session. So I think Vishal, you probably are underestimating how much you guys understand. But again, yeah, thanks a lot. If you guys have any questions, feel free to find us on LinkedIn. I know it's a complex topic, but this is sort of our favorite topic and the only thing we think about these days. So yeah, happy to chat more on this anytime.
Awesome. Thank you so much, Sanjeev. Take care. Thank you, everyone. And we'll have another educational session at some other time. Thank you.
Thank you, Sanjeev. Bye-bye.
Thanks, folks.